for joining us after that short break. We very much appreciate it. Wonderful. So excited to begin some discussion with the committee around any thoughts that we have on sort of these new findings that could potentially lead to a recommendation. So thank you all for being here. I think it might be a good idea for us to start off around, number one, if anyone has like a specific burning idea they'd love to jump in with, please let me know. Otherwise, we might want to begin by tackling the question of the current offering limits, particularly around tier two offerings that are currently set at 75 million. Does anyone have thoughts on whether or not that's an appropriate level, or if Reg A might be made more attractive by increasing that? Would love to hear what you think.
I'll just jump in. I think, we could increase to 100 or whatever, but I guess I feel like if you're a company that's raising 100 million, that does start to put you more in IPO territory anyway, in terms of presumed level of sophistication and resources at your disposal. Not in all cases, but I think in many cases. So I don't I mean, we could do it, and I don't think there would be anything wrong with it, but if the goal is to increase the usage of this mechanism, I'm not sure that would do it, because I don't think that the cap is what's limiting usage. I think that the regulatory burden, the disclosure burden, the reporting burden, and the inability to have secondary markets, or the difficulty with that. I mean, that's the friction, right? So, but I think the larger question maybe for this committee is, what is Reg A supposed to do? If Reg A is supposed to provide fairly sophisticated companies with another way of, IPO light, then it's doing its job. If Reg A is supposed to be doing something else, helping the average Joe guy, raise capital for his little company, then it's not doing that. So,
Yeah, I agree. I agree with Laura, and I kind of put a distinction from our last conversation where we did raise the limits for qualified venture funds, right? I mean, Reg A is for operating companies. So if we start with the premise that we're talking about operating companies, and if you're an operating company that's going to raise 100 million, right? We're firmly in small cap IPO territory, right? So are we trying to take Regulation A and uh, go into that territory? I don't know that you have the cost benefit there, because you get a lot more, there's a lot more work from an IPO, but you get a lot more benefit in terms of access to markets, liquidity, right? Throwing up uh, securitized offerings after you're public, right? That aren't necessarily going to be available to a reg if someone chooses to raise 100 million under a Reg A. So I agree. I don't think it's the 75 million threshold that's limiting it. Maybe you're going to bring in a few people that are like, okay, the cost analysis of doing an IPO where, average fees are now 2 million in legal fees alone, percentage basis, I want to at least raise 100. So maybe there's that pocket between 75 and 100, but I don't think that that's why people are looking at this and saying it's not for me.
Yeah, Rose, so I thank you for that. And Laura, I definitely think that based on the information that was presented, my takeaway is that the $75 million limit is not what's creating the friction. So we can maybe take that as sort of a given, but if anyone on the committee feels otherwise and would like to um, advocate for a reason to increase it, uh, we'd love to allow you to speak or chime in.
So I'm not advocating for an increase. However, I will suggest that there may be a squishy middle in there. if you just look at the reporting, I believe with Reg A, it's a semi-annual reporting plus an annual report. And then with when you go IPO, now you're looking at quarterly reporting, so you're increasing the burden. So I don't know what the ROI is. If we, at what point does it make sense to go IPO and not do a Reg A? So that's just a question that's floating in the back of my mind, if you will.
Okay. All right, great.
I'll just add on that though, but I think once you're in that territory of 75 to $1 million, if you're thinking of the compliance program that you're setting up and the cost, the incremental cost of doing 10 Qs versus a semi-annual under a Reg A, I just don't think that cost burden is now determinative. Because, again, I think it's going to depend on the company. I think there are going to be corner cases, but for your average operating company, the compliance program, especially if you qualify as an emerging growth company under, lighter disclosure rules, right? Like for a public company, disclosure rules are not one size fits all in terms of, yes, you have a quarterly report, but what's in that quarterly report. So I just think that there's maybe a corner case, but it's not necessarily going to be, okay, I'm going to do Reg A because I only have to have a compliance function for lighter compliance on a semi-annual basis versus I'm an emerging growth company and I have a quarterly compliance department that I have to set up.
Thank you, Rose. Good feedback.
Yeah, agree with that.
Okay, great. So on the topic of moving the tier 2 offering limit, it doesn't seem like we feel any action on that would dramatically change the number of folks doing a Reg A offering. Is anyone, sort of vehemently opposed to potentially leaving that part of it alone, or?
Sorry, me again. I mean, I would say let's talk about everything else. Like if there's a package, part of the package is taking it from 75 to 100, sure. But if all we're doing is an increase, I don't see the utility in that.
Okay. Yes. All right. Great. So I think we're all a little bit in agreement that that's probably not the friction point there is that offering limit. Okay, moving on to another area of friction, which is the ongoing reporting requirements. Do we think that there might be benefit in adjusting any of the ongoing reporting or disclosure requirements? If so, what do you think might be helpful? How do we feel about the reporting frequency for tier 2? And would any members support a reduction or other change in ongoing reporting requirements for tier 2 offerings, which currently are required to file annual audited and I believe semi-annual unaudited reports with the commission?
I can at least sort of kick that off. I do think that from what we heard, there probably is some merit in looking at the ongoing reporting requirements to see if there are ways to either scale them to more appropriately mirror the underlying security type. I thought it was sort of an interesting concept to explore. Where they were talking about whether or not we relook at the tiers based more on the business type than necessarily the security offering. For example, like I think if you're doing digitally secured assets or sort of REITs, there probably is a different type of disclosure regime that you could look at. The full scope of that's probably beyond the scope of what we can do on this committee, but I thought that was a really interesting thing. I think one of the difficulties is just like Rose was saying, the gap between sort of your ongoing reporting requirements as a full S1 registered company and the Reg A company, it's not all that much. So you're like, if you're, if the juice is worth the squeeze, like if you're kind of have to be subject to all these ongoing reporting requirements, you might as well just go ahead and take that next leap up to the S1. So some sort of reduction in the ongoing reporting requirements, I think is a topic worth discussing. Maybe specifically sort of the real time, the Form 1U or the 8K type of equivalent ones would probably be a pretty big reduction in the internal compliance requirements for a company. So I do think that is a topic worth discussing.
Yeah, I'll also add, I almost think of this really in a lot of the secondary markets, by the way, that allow trading for Regulation A also go to Reg CF crowdfunding. And I do think of these similarly in terms of the ongoing disclosure requirements, because I'm thinking about the fact that we now have the participation from the non-accredited investors. And so we're very firmly in the world of balancing the issue of ease of raising by the issuer with disclosures that are protecting our non-accredited investors. And so right now we have these 10% limits for non-accredited investors in our tier 2 offerings. So I don't have a solution, but if we scale that back, are we still comfortable with the scaled back disclosure when we have a non-accredited investor with the ability to put up to 10% of their annual income in one stock? Right? And in that way, maybe it is better on industry, right? Can you make assumptions and guardrails, right? Because the types of folks that are going to put money into fractional share of an art piece, right? Or that are going to, go all in on, crypto, right? Are we going to sort of make some assumptions and guardrails around who's investing in what types of businesses? And I just think it's a very sticky issue because we are allowing a non-trivial investment amount by non-accredited investors.
So would it make sense to have the disclosures be comparable to Reg CF? Like, I sort of like the idea of the simplicity of kind of applying the same disclosure. So Reg CF companies have to make certain disclosures as well. I don't know what they are offhand, but there is something to be said for kind of mirroring.
Well, but I think appropriate scaling, right? I mean, the amount that anyone can invest in a Reg CF offering versus what you could invest as a non-accredited investor in Reg A tier 2, right? There could be a significant delta in that amount.
To clarify, it's the same amount. It's 10%.
Yeah.
Oh, it is? Okay.
Okay, so I think investor suitability restrictions is a good topic and one that we can think about. But on the disclosures and reporting, the one thing that stood out to me as sort of a possible area of friction is the state level reporting under the blue sky laws for tier 1 offerings, and how that might create an additional sort of cost or regulatory burden that could perhaps be eliminated. I don't know if folks have thoughts on that one.
I was thinking about the preemption angle just because in the majority of cases, federal security laws do preempt. So this sort of stands out as an area where it doesn't.
Yeah.
I don't know how many states actually regulate in this area. I know with crypto there, since that's an area of interest here, there are a couple of states that do have their own requirements. So I imagine that does get complicated. I liked the idea, I think it came up one of the pre-materials, maybe just the state where the company is registered or headquartered, maybe those laws should be relevant. But it did seem that kind of having to comply with any state that passes the rules, like if they do have customers in all 50 states or potentially all 50 states because they're, soliciting on the internet, it does seem rather burdensome and kind of not typical in the securities world. So I think preemption to some degree, I'm not sure yet if I think it should be complete or if it should be, in conjunction with following the rules of your headquarters state. I haven't given that enough thought yet, but I'd be interested to get people's thoughts if anyone has expertise in this area.
I mean, when we talk about numbers, Rule 506, Regulation D in itself, it's Rule 506. The reason why there's so much under Rule 506 is because you have preemption, right? So if anyone remembers 505 that is gone, it didn't have preemption. It was not used. And so it is not a given that your in Rule 701, which is used for employee benefits, but that doesn't have preemption. So it's not a given that a federal securities law will have preemption. I think, Stacy in her office could probably give us the numbers that show that those with preemption are highly used, or where there's a regime, most states have put in user-friendly blue sky laws that ally with Rule 701 because there's a public policy underlying that for, equity incentive plans for employees. So we have to be mindful that it's not a given, and if it's a big, going to the states and saying, we're now going to take this over and we're going to take over protection of the investors in your states. So I think it's needed. I think for the primary offering where you have that in, tier 2, that's already similar to your preemption in a 506, that, you still have to file with the states and give them a little bit of money, but you have to tell them you did it. I think the biggest change, and I don't know if you could get there, would be preemption in the secondary markets. That would be like the uptake. If this became a more freely tradable security on OTC or on any ATS, now people are using that.
I think that's probably correct. I think the lack of liquidity, I think the downsides of Reg A, when you have sort of the reporting burdens and the regulatory burdens and the cost with that on one side, and then the lack of liquidity on the other side, make it not attractive. And so I think relieving one of those burdens, either the liquidity burden or the reporting burden, I agree would increase uptake. And if this committee is not comfortable with decreasing reporting burden, and I can, there's a lot of different sides on that, but it would seem, I agree that increasing liquidity would increase use of the mechanism.
Yeah, I'll just sort of chime in and echo everything as well, at least from like the colleagues I've talked to that practice more in sort of the Reg A space. I mean, they say that the single biggest point of friction is in dealing with sort of the interplay between the state regulatory agencies, and, especially as you're going across multiple states. And part of that is lack of preemption. Frankly, part of that is lack of development in just the overall ecosystem. I think as Daniel sort of mentioned, like or Stacy, I think you were the one that said like there's very few states that these Reg A's are even done in. So that's not just a lack of dovetailing between the state regulations and not. I mean, a lot of the state regulators are sort of grasping with issues of first impression themselves. I think that goes across the offering exemptions, but then also on sort of the advisor, broker, dealer regulatory aspect as well. George, I'm sure you run into this with like the platform regulation stuff, because I think a lot of these are being done through some sort of platform. So guidance from the SEC to try to unify and create an ecosystem that's getting along one page, I think is definitely an aspect where that could be helpful to the overall market.
So if we could like wave a magic wand here,
would it be that maybe the Reg CF limits need to be increased and there needs to be some type of liquidity for Reg A so that it's not so definitive that Reg CF is one thing, Reg A is another, and they're kind of similar, but they're kind of not. But we could actually make it so that it was like easier if people wanted to do Reg CF and maybe could go to 10 million instead of the 5 it is now. And then could we get some kind of liquidity on the Reg A side so that it would be more different?
Mm.
That makes sense?
Yeah.
And one thing I'll point out, just I know, and we've already discussed this on the Reg CF side, but to raise over $1 million in Reg CF, you need audited financials. Here we're in Reg A, you can raise up to $20 million without audited financials. So I think what you're saying makes sense, Marcia, but without getting rid of the requirement for audited financials, or at least raising the requirement for audited financials, I think there will be pretty limited movement.
That's a very good point.
Okay, great. Yeah, would love to just sort of like dive into specifics, because I do think that, the secondary trading preemption issue is perhaps one, that we're all on board with and, could sort of free up some reservations around doing a Reg A. So, across the committee, would love to get perspectives on whether we think there should be federal preemption from state regulation for secondary sales sold in Tier 2 Reg A offerings, and what we think the impact there might be.
I would preempt for Tier 1 and Tier 2. I would try to increase liquidity for both tiers.
I would agree with that as well.
I mean, Stacy, maybe from you or the staff for clarification, preemption requires a statute, correct?
Yes, that would be a statutory change. At
Right, so
least
we
that's
ha-
my understanding. I would need to double check that, but yes, I think that would require a statutory change.
Right, so we have the Uniform Offering Act that underlines the preemption for Rule 506 under Reg D. Right, so that's a statute that underlines that preemption. Could there be
And we
a
can make
change to
congressional-
Rule 144 on the holding period if you don't have current periodic reports under the Exchange Act?
We can make recommendations, they just won't be to the SEC, but we can make recommendations to Congress, or we can ask the SEC to work with Congress on making a change to a statute. And, this Congress may be maybe more, sympathetic than other Congresses to that kind of change. So I don't think we should take that off the table.
And I think we have in years past, I think we have made those recommendations to work with Congress. At least I seem to remember that we've done that in the past.
All right, great. Yeah, I think there are a few different avenues that we can go down. But it sounds like, and it's much harder when everyone's not in the room for me to get a sense of what everybody's kind of most enthusiastic about. But it sounds like people are in favor of exploring federal preemption for Tier 1 and Tier 2 secondary offerings. Yes. Okay. I'm seeing
Yes.
some thumbs up going around. Okay. All right. Great. Okay. Wonderful. So moving on to
We
another.
can do the vote. Yeah, and Erica, we can do the vote. We are, I believe, in person.
Okay.
I guess Stacey can correct me, in July. So we can do as we've done before, where we kind of get the pulse and then circle back with the group with the transcript and so far recap and then do the vote in July, if that might be easier in person.
Yes, that's definitely what I was thinking, just that today we kind of get a sense of what we would like our recommendation to be, and then in July, we could actually vote on something and move forward with it. Stacey and Courtney, does that sound like a good plan to you guys as well?
That is no problem on our end.
Okay, great. All right. Thank you for clarifying, Jasmine. I appreciate it.
Yeah.
Okay, go ahead.
Erica, yeah, so one of the things that I was mentioning on the secondary piece, and I would like some corrections for folks that might know this better than I do. In a lot of cases, if you're doing a resale, so a secondary transaction under Rule 144, you're a covered security, which does have preemption at a state level. And so if you made a change to Rule 144 specific to Reg A, such that shares that had been issued would now qualify as covered securities under 144, they would be more freely tradable. So you're still on OTS or ATS, but perhaps there would be more clarity in that space. Would that be within, yes, we should take preemption and request to Congress, but I'm also thinking about, what can happen at the SEC level.
I'm not really sure what the easiest pathway would be. Maybe Stacey or Courtney, you could weigh in on that. I don't know if trying to impact Rule 144 is more efficient than just focusing on the recommendation around Reg A, but
I mean, Courtney, were you going to say something? Please go ahead.
Yeah, sorry. I was just going to say, I mean, you could approach it either way. All I would say is that in terms of like background material and like a working knowledge of Rule 144, that hasn't been something we presented to all the committee members on. So that may or not be
Understood.
a pathway that everyone would be fully like understanding and on board with right now.
Understood.
And then often the committee takes a high level, like conceptual approach to, what they're hoping to achieve and leaves the weeds and work of it to both Congress and the Commission.
Understood.
yeah, absolutely. And I think that's probably a good strategy. All right, wonderful. The other aspect that we have not discussed, which would be great for us to evaluate, is the concept of at-the-market offerings. So currently, Reg A issuers are not permitted to conduct at-the-market offerings, which is defined as the offering of equity securities into an existing trading market for shares of the same class at anything other than a fixed price, right? So being able to sell your shares over time at the current market price when it's advantageous to the issuer. So these at the market offerings are advantageous to issuers, but present a little bit more risk to the purchasing shareholders. So would love to get folks' thoughts on whether we think the SEC should reconsider the prohibition of at-the-market offerings, why or why not, and if there's a benefit to issuers in permitting these offerings. Are there any investor concerns that we might want to consider around allowing that?
So I can start on this one, I guess. I mean, I think this is somewhat intrinsically linked to the last discussion, because it dovetails with what does the secondary market look like, and even more so, maybe even dovetailing back to the discussions about the OTC general markets and whether or not it's on a national market or not. Because I think the question of whether or not you can do an at-the-market offering really depends on, well, how robust is that market? How good is that pricing signal that you're getting? To the extent it's a really robust market, then the SEC is probably fulfilling or has greater confidence that it's fulfilling its role for investor protection. To the extent it's not a robust market or not a robust secondary market, then there's probably more concern about protecting retail investors there. So that's probably a long way of saying, I think it is a good thing to look at, but probably needs to be made in connection with the broader discussion about the secondary markets. Easy answer is probably if it's listed on a national exchange, then for sure you ought to be able to do at the market offerings. But I don't know how many Reg A's are being done by companies that are listed on a national exchange. Probably very, very few.
But it's an interesting quandary because if liquidity does increase and if the secondary market does grow for a particular stock, you can imagine that the value of that stock might appreciate in the secondary setting, and then the offerer can only offer at the original price, which then creates sort of an artificial arbitrage, and it could go either way. So that feels like a distortion. So it feels like if you're going to open up secondary trading, that probably you need to allow the issuer to issue shares at market. But that could be wrong and simplistic.
No, I agree, because you've offered up the market to buy at the price, but you've locked out the issuer from participating in the market. I would point out that right now the default limit, I guess, for a public company, if you are listed for an at the market, is 75 million, or there's rules that if you have less than a 75 million in a float, there's limits on how much of your securities you can offer in an at the market offering. So because we're talking about our current 75 million limit, or maybe going up to 100, a proposal here, I think, has to have those limits, right? So allowing the company to participate in now this market that we're trying to create. But I just looked it up because I didn't remember off the top of my head. It's a third of their public float in any rolling 12 period that a publicly listed company with less than 75 million in a float can offer, right? So I think we should be thinking about, scaled limitations to align with that.
Okay. What do we think, do we think that the benefits outweigh the costs? And do we think that this has actually been an impediment to people using Reg A? I mean, my particular opinion is that yes, obviously, there's some benefit for the issuers to be able to do this, but also I kind of wonder, how material is the inability to do at the market offerings in terms of whether people decide to do Reg A or not. Would love to get some thoughts there. Do we think that's actually been an impediment, or would this just sort of be like a bonus to the issuers?
You mean a bonus to the issuers that would use it regardless, as opposed to bringing in new issuers?
I just mean a bonus that, okay, I guess that's what we're trying to figure out here. Do we think that the fact that companies have been restricted from doing at the market offerings has prevented them from choosing the Reg A pathway, and folks who may not have chosen the Reg A pathway would now be more likely to do it because they can do at the market issuances?
May I just a clarifying question for some of you. If I'm hearing this correctly, if we do the aftermarket offering, we're basically offering at a significant discount based on the current regulations. Am I hearing that right? We're forced to discount the offering. No? Okay. Can you clarify that, or am I asking a question that doesn't make sense here?
Well, I think, and someone correct me if I'm wrong, but the at the market, being able to sell the shares at the market means that you don't have to stay with the price for the securities that you're gonna sell is. You can just do it at like whatever the
The
trading
market is.
market is.
Okay.
So if the market goes up or down, which either one could happen, a company can just sell into that at whatever the fluctuating price is.
Okay.
Versus the way that it's done right now is you set a price and the company just sells at that price. And then the trading market is sort of independent of that price.
Yeah, and so I think some of the, issues there, either, whether the price goes up or down, there's like less visibility for investors around dilution, in terms of how much is going to be raised. There's just greater uncertainty, for investors that are coming into the round when the company has the ability to sell at the market. And if, folks have sort of other perspectives on how this essentially transfers some risk, from the company to the investor class, which is kind of where we're moving risk when we shift, regulations. Would love to hear those perspectives.
I mean, my perspective on that is if we have a robust secondary market, while the risk of dilution is still a risk, it has been mitigated because now an investor has the ability to exit and get liquidity short of an exit event for the company itself, where that investor's ownership percentage is now critical, right? So we're now closer, I think the baby IPO concept is more relevant in that analysis. So I would say that they go hand in hand, right? If you have a robust liquidity for your investors in the secondary market, then you're allowing the company to also participate with guardrails to a certain degree. I think having an at the market without the secondary trading, I agree with you, Erica. I think that would be shifting too much of the risk to the investors.
Okay, great. Thank you, Rose. All right, wonderful. Let's see. I think a couple of the other aspects that we should probably discuss, include a little bit about any mechanisms that we could consider to help reduce the cost of the offering. So, on the audited financials, would love to get people's thoughts on the requirement for that. I believe it was 2 years of historical audited financials plus ongoing annual audited financials. Would love to hear creative solutions or anyone who sort of has real world experience with this maybe being a hurdle for people who otherwise might have been interested in doing a Reg A offering. And the other thing that we didn't really discuss yet, but there is an option in certain cases of getting like reviewed but not audited financial statements, which is kind of like another sort of slightly less costly option that can give people a little bit of comfort in the accuracy. But would love to get folks' perspective on that.
So Erica, it's Wendy. I'll weigh in. I thought we said earlier that really the financial statements, although it was, it's sometimes mentioned as a burden, it's kind of a common complaint that even issuers make. There's too many requirements. I don't, in my experience in my firm, the 2 years of audited financial statements under AICPA standards has not been a challenge. Typically, any really, a good operating company has sought financing elsewhere and has had to have audited financial statements. So there really isn't a burden. The big complaint comes in when they want to move up, but they're still small and all the controls that are required and a PCAOB audit. That's where it incrementally becomes very costly. The company typically has to hire more people. So, I think some of the other things that we're talking about, and I'll just throw in here, I don't understand how to relieve the state burden. I don't know how that works between federal and state requirements, but that to me, along with the secondary offering, seems like or the liquidity piece seems like the way to go, and really spending time on the financial statements is probably not going to be a good use of time.
I agree. I mean, the cost of a 50-state blue sky analysis based on the circumstances of your off, I mean, I don't know that we have to get into numbers, but for a well-oiled operating company, that may be right up there with your financials. That's a very comprehensive analysis. States are all over the map, literally in terms of how they regulate securities and how it's codified, and whether or not you can pick up the phone, like we heard, pick up the phone and call the SEC, whether or not you can pick up the phone and call somebody at a state securities regulator, whether or not they're willing to talk to you, you can even get them on the phone. So that's a very, in a legal practice, when you're talking to clients about, are we truly doing a 50-state offering, and do you want to have clarity on your pathway across every 50-state and DC? Very expensive. So preemption, I think, goes to use and cost.
Yeah, I just would have to agree with that, Rose. That's what I've seen in my experience, just even when clients have even just thought of the idea of using or leveraging Regulation A, just the analysis alone with, looking at each state law is just a deterrent, because, while they're leveraging the marketing piece, so being able to market freely, that's great, but that also means that they're going to be encountering investors across the plethora of states. And so once they hear about that, the conversation then changes to other offering types. So it's a huge disincentive that I've seen in my experience.
Yeah, and it's an evolving landscape. So one of, I think there is leverage in some states and practitioners that do that because they are iterating on prior analysis, but the states change at inconsistent and widely varying frequencies in terms of both their actual regulation and case law interpreting those regulations. So you can't even, I would say that, most experienced, securities practitioners wouldn't even be comfortable picking up something off the shelf from last month and saying it's still good in all 50 states, right? There's still an incremental cost involved.
The other sort of, I think, significant area of cost is probably on, just the internal retooling that you have to do as a company to be prepared for current reporting. Just because that effectively means you probably need an internal general counsel and more sophisticated financial systems and operations. So even just the ongoing, just being able to get tooled up internally to be in a position where you can comply with these ongoing reporting requirements, it's probably you're hiring probably one or two full-time employees as well. So I think that's probably a fair amount of cost associated with that.
Yeah, I mean, Bart, if you have some, perspective on that, would love to dig a little bit deeper. I'm curious, it does seem to me that, with current resources and technology and, if you're raising, 10 million or however much it is, even if it's just one person that needs to be in charge of that, I mean, is that, such a burden, or is that something that we feel that the investors are entitled to, that you do have at least one person in your company who's sort of really going to stay on top of all this stuff? So, would love to get a perspective. Is the burden really so high given sort of the current state of technology and financial reporting software and tools available? And B, is it too much to ask that there definitely is somebody within the organization who is going to take, serious responsibility for tracking and reporting financial results to all investors?
Yeah, I think great questions and great points. I think depending on the amount of raise, like certainly probably should be an obligation to do that. My only point was like, if you are a company and you're evaluating whether or not I'm going to raise money through Reg A or Reg D, and one of them says, you don't have to do anything, you don't have to retool, you don't have to get any new accountants, and one of them says, oh, by the way, you're going to have to hire an internal GC and get an internal compliance system. Like that probably does factor into the equation. Not saying that's not the way it should be, but if we're sort of looking at the reasons of why Reg A isn't more utilized, I think that does probably factor into it.
I think this also goes back to what we heard, that Reg A is mostly being uptaken by niche businesses. Because if you are that business that does have the, one headcount or more in terms of compliance and operations, maybe you don't have a huge network of funds that you're going to, but you probably are able to sort of tap into that network. So a Reg D offering is on the table for you because you're hitting some quality metrics that a fund would be looking for to allow you to raise the dollars you need in sort of that more closed universe Reg D, where in a niche business, right, you're intentionally going broader to folks in that ecosystem that you're not necessarily connected to, or you want the non-accrediteds that are passionate about that area, right? So I don't think you can completely sort of untangle the quality of the general operating business, which means the likelihood that Reg D is a viable path for you with its lower burdens, from sort of that niche business of why you would go to Reg A.
All right, great. One more question on cost control, that we might want to think about for tier 1 versus tier 2. So right now, under tier 1, right, you do still need the audited annual financial statements, correct? Do we think that there's any excessive burden created by that, or no? It sounded like Wendy said probably not. I just sort of want to see if that's one, that we don't feel that we need to look at. And if there are any other specific ones that we could form a recommendation around, that we think are meaningful. I'd love to hear.
So I'll just weigh in there. The issuer does not need audited financial statements to do a tier 1 offering.
Okay, so going like after they've done the tier 1 offering, they do not need, and it does not need to have an annual audit.
I don't believe so. I would need to double check, but I think when you do a tier 1, you just file the 1Z at the completion or termination of the offering. I think I'm looking at Rose shaking her head. Yes, I think
Okay.
That's my understanding, and I think that's what we heard today.
Okay, so
That's my understanding as well.
okay, so only
Can I
tier
add-
2. Yeah, go ahead.
Sorry, I just wanted to add one thing while you're in this discussion too that I didn't share earlier, is that the data we have does show that most of the offerings and proceeds are coming in under tier 2. So as you're thinking about this difference between tier 1 and tier 2, I would say Reg A tier 2 is the predominantly used, which I don't think is a surprise to anyone.
Okay, all right, great. Okay, fantastic. So I think we don't have any particular incentive around addressing costs through, whether the financials are audited or not. It seems like the current reporting requirements we don't have motivation to sort of change that cost structure.
So, Erica, I don't know if there's any information on this, but what I was trying to say before as well, I don't think the financial statement requirements are necessarily incremental for any of the people that might be taking advantage of Reg A. So, and for the teeny tiny population that it is, it's probably not worth the energy.
Yeah, agreed. Okay. Definitely agree. Just want to make sure nobody else has kind of like a, important sort of dissenting opinion there.
Right.
Wonderful.
And I'll
Go
just
ahead,
add, I
Chris.
think one of the reasons why tier 2 is used more than tier 1, and this goes further into preemption. I truly do believe that the cost savings is in preemption.
The
I
preemption.
think that's why you're seeing people use tier 2, because it has preemption for the primary offering. And just for those that aren't familiar with the patchwork of states' securities laws, you offer to unaccredited investors in a primary offering in a non-preempted in states at your own risk. I mean, it is the disparity of requirements and regulators at the state level. If you are going to an investor that does not qualify as an accredited investor, can be, depending on where you are. It may be super easy, depending on who you are. It can be very costly. Like, you're giving disclosures akin to an IPO sometimes in terms of financial statements. So I cannot underscore enough, like, preemption and cost savings do go hand in hand, as well as with uptake, in my experience.
Okay, great. Thank you, Rose. So it does feel like everyone is, we're fairly on the same page around a recommendation for federal preemption from state regulation for secondary sales by investors in tier 2. Are we also considering recommending federal preemption from state regulation for tier 1 offerings?
I would
Yes, I
say
see.
yes.
Okay, I see heads shaking yes. Okay. All right, great. I think those are some pretty meaty areas for recommendations. Anyone who, maybe has a dissenting opinion on that?
I'll just say on tier 1, because there is more limited ongoing reporting, to think about a secondary market in tier 1 is a little harder with non-accredited investors. I'm 100% supportive on the tier 2 side. Tier 1, I need to unpack that a little bit further.
Yeah, I agree. I was shaking my head no on that. I don't think, yeah, I wouldn't want to discuss that further, because the secondary market is presuming some level of available information, as we heard in our last meeting, right? About how the OTC has evolved and the information that they're able to gather from companies as an investor protection mechanism.
And I would tack on to Rose and just remind everyone, with OTC, secondary trading is for tier 2 companies as well, because of that very reason, because the disclosures exist.
All right, wonderful. Do we have, any thoughts around? I mean, I guess we don't really have to worry about tier 1. It sounds like, because it's not being primarily used. So maybe we will just focus on the tier 2 liquidity improvements. Any other sort of ideas or thoughts beyond federal preemption for secondary trading of tier 2 issuances that we think could help either improve liquidity or decrease costs that haven't been discussed already?
Well, I was just gonna mention this back on the tier 1 thing though. But if the idea was for tier 1 to be used, I just think we should give consideration to the the state law exemption, because I think that's one of the primary reasons why Tier 1 is not being used. And so to the extent that we are interested in increasing the use of Tier 1, then that's probably something that we should reassess.
And that would be preemption for the primary offering, right? When the issuer,
for the
yeah,
primary.
I agree. I could be more comfortable with that than on the secondary piece.
All right, great. Well, I think,
Hey,
yeah, go ahead.
hi, can you guys hear me? Hey, this is Danelle. So
Yes.
I worked for 4 or 5 years at doing tier 2 with my startup. And I think the kind of cap table management piece post tier 2 offering was the primary blocker. So I just wanted to mention that I'm about to take off, and I wanted to make sure I got that in. So having VCs on the cap table, then doing a tier 2, then thinking about doing an IPO post tier 2 Reg A offering was kind of the barrier that stopped us from ultimately implementing, if that makes sense.
Okay, could you be specific around what aspect of the tier 2 offering you think would have made, future transactions difficult for your company?
I think the things that we've spoken to about the kind of secondary market, the kinds of constraints around the secondary market, and then I think the traditional tension between the venture capitalists and having crowdfunding retail investors on their cap tables generally were the fundamental constraints. And I think I can speak to strategically that was the issue we kept running into. I'm sorry, I don't recall which of the couple points that we've gone through today could unwind or fix that, but I just wanted to mention that overarching issue for us and for other similarly situated, VC-backed startups who were kind of looking at tier 2 as, all right, we're not fully ready to IPO. We don't want to continue on the venture capital track with like a Series C. A lot of climate tech companies actually needed to become more tech-enabled services companies, frankly, in highly regulated spaces that aren't as quite a fit for VC, but also profitability isn't there for PE, and so tier 2 Reg A seems like a good option. But this issue of being VC backed, then doing a tier 2 offering, and then precluding later IPOs is the issue that we all kept running into. I will dig into the notes from today and circle back via email. I have a couple questions for the council, both from Lowenstein and both from FINRA and others to get more specific, but I just wanted to mention that for folks on the call.
Okay, thank you. We really appreciate, go ahead.
Sorry, I'm mindful of our time, but just one minute, and I'll put sort of my investor experience hat on for this. One of the reasons in my experience that investors don't like having the crowd, and I would use the crowd here both under Reg CF and potentially under Reg A, is now control going into those IPOs and controlling the destiny when you're going to get liquidity. As we're seeing companies stay private longer, one of the biggest complaints from the investment community is, where's my liquidity and where's my exit? I think if you marry this with a robust secondary market, that you now have the fund's ability to get liquidity and distribute out to LP at perhaps prices that are truly being made into a market, because you both have the secondary and, to a limited extent, the company being able to do at the market, I think you can actually address some of those concerns. Right? I think you could probably bring the investors on board because they see an exit pathway.
Concur. I think that's exactly right.
Yeah. Okay. All right, great. So perhaps, these recommendations around improving avenues for secondary liquidity might help to solve some of this VC bias that you're bringing up here. All right, wonderful. Well, I just want to thank everybody for joining today. We really appreciate, this incredibly thoughtful discussion. And I also want to give everybody, some visibility into our upcoming meetings. So we've selected the following dates for the committee's quarterly meetings in 2025. July 22nd, 2025, and November 4th, 2025. We aim to be meeting in person in July, so looking forward to seeing you all in person. Committee members, please mark your calendars. And this is a friendly reminder to log off of this WebEx call and log into the separate WebEx that was provided for our executive session, which will begin right after we adjourn. So I hereby move to adjourn the meeting.